All right. So primarily our title here is update and opening up of the economy. So I'll make sure I get this shared properly. Our typical disclosures that we have, obviously make sure that anything we discuss is, you all know, is my, let's go back, is my opinion and my opinion only. So read along. This is the least interesting slide of the day, I hope. So, all right, so our outline for today. So we're going to talk a little bit is April in review. So, the height of the sell-off obviously was going through the month of March. April was a whole different story, and now we're almost 2 weeks into May. So we're going to just kind of go through what happened in in April. We'll talk a little bit about the opening up of America. And this stuff is changing daily. I mean, I'm literally getting alerts today as I'm prepping for this conversation about some of the changes that are coming. So bear with me as we try to keep you up to date. One of the things that's been discussed a little bit is some of the struggles with the state and potential state bankruptcy. So I'm going to talk a little bit about that. We'll talk briefly, give you an update on what was going on with earnings of companies and some of the decline that we saw. The oil markets, it's been a really strange dynamic, with prices plummeting because there's essentially such a lack of demand. So we're going to talk about some of that. And I have some really cool charts to kind of go through. I'm utilizing a lot of the slides from a Raymond James presentation from last week. So it was really good content. I kind of cut it down probably over half. So I try to really take a snippet of the high level items that I thought would be valuable for you today. And then just trying to give you an update on the California stay-at-home updates, which honestly is kind of confusing, but I'm going to do my best to explain. So I hope you enjoy. All right. So I will warn you ahead of time, and I hope you have a large screen, because if you're using a phone, this is going to be impossible to read. If you have a TV you're on, it's going to be even better, or a laptop should work, or an iPad, but it might be a little small. So as I'm going to go through this, there's a lot of content here. I want to make sure I'm explaining what we're seeing, because sometimes charts are actually really easy to understand, but they look noisy. So what we're going to look at here is really, what happened in April. And so, the stock market really waged a massive recovery, a massive bounce off of the sell-off in March. And so if we're actually looking here, and I think let me get my pointer. I think I can get a little pointer option. Here we go, my little laser pointer. So if you look at the sell-off, so what this measures on the left-hand side is the sell-off in the market. This is based on a monthly basis. So you can see the March 2020 sell-off, which is right here. This shows that this was the worst month since 2008. And then if you actually look at April 2020, this was the best month since 1987. So what a dichotomy, right? If you think about a couple different times in our history is, and we kind of know this with the stock market, when you have a really bad month, it's usually followed by a great month because things just kind of bounce back. And that's really what we saw. Now, the hard thing I think for investors to wrap their arms around is we all see all the economic pain still, right? Unemployment is still going up. We know countless stories of people who are struggling, businesses that are struggling. And so it's kind of hard to wrap our mind around, well, what's going on with the market and why is it disconnected from the economy? And the key to this is that the stock market is always trying to anticipate the future, right? The value of companies is based on the future, not just only based on today. So they're trying to anticipate what's coming ahead. Is there good news? Are we going to recover? And I think that we are starting to see some recovery ahead, but it's a long way out. And the markets kind of don't care. They're looking at that saying, you know what, the sell-off may have been so big because of the panic, and now we're coming out of this. And I've had dozens of conversations with clients over the past 6 weeks. And the hardest part for all of us as investors is to reconcile the fact that while we all know the economic conditions were going to deteriorate, that we couldn't even fathom the stock market bouncing, and look at what it did. And so it's a good reminder of why we don't try to time, why we become investors, why we focus on long-term, because this short-term stuff, it's anybody's guess. I don't know what May is going to be. It's an exercise of futility to try to predict what the future is going to be. Nobody knows. Experts don't know. People have opinions, but at the end of the day, you don't want to be making financial decisions around a series of guessing, right? Because we all feel like we know the future, but when you're just making these decisions, it's just a guess. And that just doesn't work over the long term. We know if we have faith in America, faith in the process, faith in being a long-term investor in stocks and real estate, we will be rewarded over time. And that's just fundamentally part of our core belief, is that you have to ride through these tumultuous times. That's why asset allocation is so important. So kind of got stuck on this slide a little bit, but it's just a reminder of, when you have, what's the expression that the day is at its darkest point right before dawn, right before the light comes up. So, that's one of the things we have to remember, is when you have these kind of weak periods, then the recovery tends to be quite strong. Over on the right-hand side, and for some reason, it's got a little bit messed up here when I actually did the PowerPoint presentation, but it looks like, so one of the things that we're looking at here is this represents the sell-off in the market. So this first column is energy, right? You can see how bad it was for the year. It's down over 30-some%. And then you can see actually for the month, energy was the best. So who would have thought that energy would be the best performing sector in April in an environment where energy actually technically went negative, right? So that's one of the things that's the hardest thing to get our mind around, is that if you would have made an investment on April 1st, the energy sector was the single best performer, even with all of this backdrop of what was been going on. So all 11 sectors were positive in April, but only technology is the only positive sector year to date, at least as of the end of April. So one of the crazy things that happened, so this, I'm not going to look at all these charts here today, but up here on this top left, this oil prices briefly turned negative. So the way that oil is traded is using contracts, right? Because if you're buying and selling, you can't physically say, here's my oil, I'll take your oil off your hands. It's hard to contract that because oil is hard to move. It's not like dollars where I can hand you my money, you can hand it back to me. So they're traded in contracts. And so because there was so much oil in the market, actually oil prices went negative, which means it actually, it had no value. People couldn't store it anywhere because the demand wasn't there, and all the storage facilities were full. So it literally went negative, which means if you owned it, it cost you to get rid of it, which is crazy, right? So that's what it meant by oil going negative. And so, which is pretty insane. And that was just because of storage capacity issues. Technically, you guys noticed, you went to the pump. It didn't mean gas prices were negative. That would have been kind of strange, right? So, and then down here, U.S. leads the broad international, U.S. leads the way with the rally. And so if you look at this just shows different indexes like the S&P 500, the world, emerging markets, Asia. So it just kind of goes through a couple of these key indexes. And basically what this shows is what was the performance during April. U.S. was the best performer in April. So it was up 13%, really strong April, still negative for the year. And then if you look here, China equity performance is actually down 4.5. So China, shockingly, is the best performing asset category in the world from a stock market perspective year to date, which is actually pretty surprising. Until I did this presentation, I did not know about that. Again, I'm not going to go through all these items because I can bury you guys with charts, and that's no fun for anyone. So, all right. So last time we talked a little bit about this idea of this K recovery. We're hearing a lot of, for those of you who haven't joined me for these different ones, but if you think about a recovery, so when you go into a downturn, you fall this way, right? You go into a downturn. And when you think about what the recovery looks like, we have a couple options, right? You can have a V recovery, which means we bounce straight back. We could have a L recovery, which means we recover, but it's really slow. You could have a swoosh recovery, which comes down and kind of comes back, very similar to an L. So one of the analysts at Raymond James kind of put together this idea around this K recovery. And the K recovery just basically represents that there's a lot of different paths that companies are going to take, and that it's not a clear path based on just the overall economy, that it is going to be very much industry specific. And there are certain industries that, as we were getting into this close down of the economy, that actually thrived. There's businesses that continue to operate and actually were busier than ever, and they just kind of had a growth spurt, right? And then you had some that initially fell, but are on their way back. And some of these charts that we're going to look at here kind of represent probably a little bit more of that, right? An initial fall, and then they took off. And then unfortunately, we're going to have some industries that just totally die. We're already seeing bankruptcies starting to pick up with retail, some of the big old clothing retail, like Neiman Marcus, places like that, JCPenney's. But if you look at here, look at some of the items. So this top left chart is food consumption off premises. I didn't know they kept track of that, but apparently they do. So quarter over quarter, it's up 25%. Well, duh, that makes sense, right? Because people still want to get food. They don't want to cook for themselves all the time, and they're purchasing food for pickup. We're doing that at our family. We also want to have some variety with what we eat, and we want to support local businesses. And so that's been a big part of what we're doing. Down here, annual bankruptcy filing. So bankruptcy paces, the pace is beginning to accelerate. It's probably going to be the second biggest year ever. We haven't really seen the full impact of that. The one thing that I want to remind everyone around bankruptcies is that obviously that's not a good thing for the business or the owners of those business or the employees of those business. But a lot of times bankruptcies don't always mean that a business goes through bankruptcy and then goes out of business. And bankruptcy could also be they need to renegotiate their debt, renegotiate their terms. And that's sometimes a structured bankruptcy where they do that, and then because they're improving their overall books, they can then continue to operate. And so there's going to be some failings, some bankruptcies where they just liquidate and they're done, like Sears obviously went through a few years ago. But that doesn't always mean the company's just closed and they're out of business. But we know that's going to pick up. Home maintenance spending. So you can see this is kind of just looking at what we've seen. The home maintenance spending projects have really picked up here. I think as people were cooped up at home with nothing to do, that weren't working, we're looking for projects. And so clearly the spending picked up. So that's a growth area. And then an area that, has really struggled, and we probably don't put them in the fail category, but probably the deeper, harder industry to recover from is the auto sales. So, look at what we're looking at here. So this is the lowest pace on record when you're comparing, looking at in millions US monthly auto sales. And so it literally just fell off. And so if you look at the last time we had that, these are during recessions, right? And so that's a massive fall off. And that's not going to come back until we start getting back online, because we're all been sitting on our cars, not driving that much. And, that this is going to take a little bit of time to repair, and auto dealers are struggling because of it, and auto makers as well. So that's an area that certainly has a lot more room to go. So a couple things we're going to go through. We've been talking about what are the big four areas that the catalyst to drive the stock market higher, to drive investments higher. And when we start looking at, what is it going to take? The first two items, which I've spent the most time on, are aggressive monetary policy, aggressive fiscal policy. So again, coming out of the Fed, coming out of the government, meaning Washington. And then those two things have been the strongest amount of stimulus we've ever seen. I do believe, and I did not read an article on this, there's another proposal coming for another $3 trillion. Yes, $3 trillion. So we already know we've been dealing with funny money. I think we're up to $5 trillion on this, and now another 3. So, why not make it another trillion? At some point, we got to curb the pain, but, we got to be a little bit more selective now. So I think the immediate response needed to be directed at everyone to slow down the panic, to make people feel comfortable. Okay, they're going to be fine. They can take care of their basic necessities and needs. But now we're getting to a point where in those cases where there's true hardship, we need to be a lot more like a laser focused, or much more of a rifled approach, where we're focusing on those areas that are in need and then can show that need, instead of just this blanket support for everything, because we're just now doling out it's getting to a ridiculous amount of money. Again, I was very supportive of it, but I think we got past the initial panic phase. So we need to be a little bit more selective with how we're doling out the money, because we want to just be careful that we make the right decisions for our country. We also don't want to make a permanent welfare state where everyone just gets used to having handouts, and then you don't need to go back to work. And actually they may not go back to work because they'll make more money sitting at home. We don't want to create a perpetual environment where that is now becomes the new norm. So I'm still hopeful that that's not going to be the case, but we just need to be a little bit more careful there. And again, that's just my opinion on how I feel about things. But I like what's been happening up until now, and we're going to have to revise it and make some adjustments. But let's be a little bit more cautious now and a little bit more strategic about the decisions going forward. And then the two other areas, which are, a little bit of, what unknown is the question mark, is the development of a therapeutic or a vaccine, right? So, that is still to be determined. I feel like every week we have a headline that says, oh, we have great news. And then it's like, oh, never mind. Or it's such a small group. Is it really significant? And then the dominating the nightly news, I hate to be the bearer of bad news. This is never going to turn from an X, especially in a political year. The news is designed to keep you watching, to keep you scared, to keep you, I want to say even sometimes ill-informed, because the information on the news is really poor. So unfortunately, that's not going away. I don't see us getting an X off of there. And the development of a therapeutic or vaccine is just going to take a little bit more time. And so hopefully the two, the monetary and fiscal policy will really drive the efforts. And, we're seeing this with our clients, with our business clients. They're feeling that relief. I don't think people are super optimistic, but they're not in a panic phase, which is really what this was designed to do, is stabilize things so we can get back to work at a more normal pace. And we're starting to see that. Even though California is not technically opened up, we've been noticing, and we're an essential business as a financial services firm, but we've been noticing more and more parking lots being full. We've been noticing a lot more cars on the road. So I think people are starting to either, one, getting tired of it, or number two, just realizing, all right, we got to get back to work because, a lot of companies can't stay closed for forever. Or for a prolonged period of time. Okay. So this is one of the interesting little charts I was kind of looking through. And so we have kind of on the left-hand side, which is contact intensity. So meaning if you're going to do something, are you going to have low contact or high contact? And then like contact frequency. So, if you're in an area, like, are you going to be around a lot of people, right? So you have intensity, which is measuring one, and then frequency, which is measuring the other. So if you think about like going to a park, you have a low intensity and a low frequency. If you're in like a rideshare or a taxi, right, that's high contact because you're close, but it's low because it might just be you and the driver, right? So you don't have this frequency. And then as we start going out in this red areas, I think what all of us are trying to figure out is how are we going to get back to normalcy, right? So when you think about maybe this first batch, theaters, museums, residence halls, right? Schools, are they going to go back? Community centers, how do we keep some distances? Schools probably could be in that category, but I know for my kids' schools, they pack 30 plus kids in a classroom. How are they going to manage that? Right. So, restaurants, gyms, playgrounds, that's kind of in the medium area. And then high, right? So this is kind of the area of probably the economy that's going to take the longest to come back, because we know there's high contact intensity and high contact frequency, airplanes, bars, large venues, right? Sporting events, things like that. So childcare facilities. So even though this is at a high risk area, they've had to open these facilities back up because, if you're going to have workers go back, they need to have a place for their kids to go. And so, I know they put lots of limitations on there to protect families. And so just a really interesting dynamic when you start seeing the decisions that states are going to make, cities are going to make to start moving things forward. And we'll talk a little bit about what's going on with California, but the low intensity, those things have already started to open up, and it's getting a lot easier to, I don't want to say get back to normal because we're not near that yet, but we're starting to get back to at least being able to do some daily habits like going golfing, things that a lot of people were doing as part of their ongoing habits, going to the beach, doing things like that. So, so this was kind of, I found an interesting chart, and I think it just kind of comes back to speaking towards the strength of, I guess, how deadly the COVID-19 is versus seasonal flu. Now, I do want to be careful here because this is a real hot topic. I think a lot of us have been either underwhelmed or totally distrustful of the information that's out there around what we're getting from different sources, whether it's the World Health Organization, from our government, from CDC, a lot of information. And again, I don't claim to be an expert there, but it looks to us like when we're seeing like things like the seasonal flu, that the seasonal flu, only 2% of seasonal flu cases end up in hospitalization, where about 20% of COVID-19 do. And again, that's also based on testing. So we might have a lot more, and this number might come down. This is just based on what we know today. So, but we also know that, fatality rate is higher on COVID-19, and it looks like even on the lower end, it's probably about 10 times as deadly as the flu. So again, I don't pretend to be an expert. I do think these numbers are actually reduced. I think initially when this started, when the panic was at its height, the severity was potentially overstated because we didn't know. But it seems like, now we're settling into a more realistic view of this, but it's still obviously, significantly more deadly and more contagious, which is obviously why we're trying to curb this. Now, this freaks me out a little bit when we start talking about tracing people. So obviously, if we want to do this at the highest level, understanding who is infected, who are they around, and who are those people around, right? So you have this kind of, I'm going to kind of follow the bouncing laser pointer here. Identify the infected person, isolate the infected person, trace all known contacts, notifying their exposure, and then prevent the spread of the disease, right? So, but this also has a massive issue around our personal liberty and our personal freedoms, right? So in order to do this appropriately, what do we as a society have to kind of sign up for? What are we willing to do? So I'm going to go through a couple of these. And again, this is some really cool data that Raymond James put together just to help summarize this. But, while we get it that it's productive, at what cost? And then is this going to become the new, I think the fear that I have for this is this going to become the new norm, right? Anytime we have any sort of little thing, now this becomes, we got to instigate this, or will this be isolated to just this issue because of the severity of it, right? So you have a traditional approach and you have a tech-based approach. And so if we go, I think this was, so we have, I'm going to go into a little bit more detail here, but if you have, the traditional approach and then you have the tech-based approach. And so let's talk a little bit about what these are. So if you're going to do manual contact tracing, you're going to need a ton of manpower. Frankly, I just don't think it's realistic. I mean, look at this note here. Estimates have called for as many as 100 to 300,000 of contact tracers. I mean, getting that many people as a workforce geared up to go do this just seems silly, seems impossible. You can see down here, California plans to hire 10,000 contact tracers. Again, I'm no expert here. It doesn't feel like a good idea, but that's maybe my limited knowledge on how I understand this. And then the tech-based approach, I think the tech-based approach obviously is a great opportunity, right? Because it's easier to implement, but then it also has, a big issue around our privacy, right? Privacy concerns, technology challenges. And so I don't know what my opinion is on all this. I kind of have this sense of like, let us get back to some normalcy, but do what, put what we can in place to provide a safeguard. You can't lock people in their house. At least that's, I wouldn't want to see that either. So, and then this thing is kind of interesting, right? Using Bluetooth to detect when two phones are close to each other for a set of time, and a digital option can notify anyone who is potentially exposed whenever someone tests positive. So that's really like Big Brother at its highest level, right? Where they're watching our every move and detecting who is near each other. So I don't think I can get on board with that. But I understand that's what our government's trying to face here. How do we move from where we were to a government that's now throwing $5 to $8 trillion at this, which is going to create a ton of debt for us long term? And how do we get back to some normalcy? So do we take these steps that really infringe on liberty, but in order to get us back to some normalcy? And so in normalcy, I mean, I got to put in quotes on that because it's like, what is that? What is normalcy at this point? So a little frightening on some of this stuff. And I know this has been a little bit maybe successfully implemented in some countries, but I think a lot of Americans are skeptical about this and concerned with this in terms of just protecting their privacy. So this was kind of a thing on here when you start looking at like creating apps and like doing, kind of watching like what some of the, I guess how the different countries are going to do this. And I think from a data privacy perspective, the US and Canada has kind of been on that side of like, no, where this is too important for us. And, from an execution or a time perspective, a lot of other countries are like, we need to do this, that we don't really have it. This is from a time and a manpower, we have to put this in place, and that kind of outweighs data privacy. So US is still on the side of data privacy, but, we've also been the most affected. So, is that going to change? Again, don't have an answer for that, but that's something that we'll be keeping an eye on because we're seeing cities open up, states open up. We're also seeing citizens that are getting tired of being cooped up and that are saying, I'm going back to work. I'm going back to normalcy. You saw Elon Musk. There's been headlines in the last 2 days where he said, I'm opening back my plant in California. And if you want to come arrest me, I need to open back up. And oh, by the way, I'm going to move my headquarters to a different state because, you guys should not be able to stop me from working and stop me from running my business. And so, we're starting to get more pushback, and the longer this goes, the bigger the pushback will be. So a couple quick things, that I just want to address. So essentially states cannot file for bankruptcy under current law. So there's been some chatter that obviously this pandemic is causing a massive strain on local economies, right? Because local economies, state economies, they're getting tax revenues from businesses, from taxpayers. The state is being impacted because they have an unemployment fund that's being tapped by millions of people across the state, but obviously across the country. So a lot of their reserves are getting drained. So there's been some chatter, well, they could file for bankruptcy. And so, but states cannot. So bankruptcy laws and interpretation of the Constitution would need to change. Now, from a lot of experts, that's not likely. A lot of our states actually maintain a pretty high credit rating and actually have decent debt profiles. So, where people, certain cities or municipalities can declare bankruptcy. The other thing too, you got to remember with states, they have the ability to raise taxes. They have the ability to raise money through more municipal bond interest. And so, the one thing that we do think is going to be coming from this is that the federal government is going to have to provide more support to the state governments. So it's going to feel like a little bit of a bailout, meaning some of these trillions of dollars that are going to come directly to the states to be able to make their payments. But I know, again, we're in a political dynamic, and I know that, you have a big, obviously with Trump and a lot of the more, the blue states, there's going to be a lot more fighting on, how do they apply those resources and how much money comes into these states. And unfortunately, yes, things become political, and it's going to be tough. But it's not likely that the states are going to file bankruptcy again, because they can't unless the Constitution changes. This is really hard to read, but it basically talks about interest payments. Hold on, my picture is about here. Interest payments is a percentage of direct spending. So if you think about how much a state spends, and if you look at what their interest payments are, so you can see like California is at 3.5%, Texas at 4%. So even with these are their interest payments. So as a percentage of their total spend. So, we're not seeing, it looks like the top one is Illinois, and we know Illinois and New York are the top two. It's right around 5. So even at that, it's still a relatively low amount as a percentage of their whole economy. Obviously not a good thing if states take on more debt, but they're not at a problematic level just yet. But we're going to start seeing some really big numbers in the second, third, and fourth quarter of this year, because there's going to be massive strains on the state economy that we got to be aware of. And that's what's going to probably cause more volatility in the stock market. We've seen this nice bounce from these levels. We're probably going to see a lot of this because we're going to be bombarded with negative news, negative headlines, issues at the state level, issues with companies. This is not going in any way anytime soon. And so although we're optimistic about our recovery coming out of this, from this initial bounce, which is a pretty strong one, it's about 30% from the bottom. We think that the move here is going to probably be a little bit more sideways as we work through this. Especially as a broad economy, certain companies are going to continue to thrive and do well. But this is going to be where we're going to have a lot of information around what's going on with the states and how are their budgets holding up. And again, on the surface right now, things look pretty solid, but that's obviously going to be changing and adjusted. So a couple things, and I don't want to spend too much time on here, just kind of shows different periods of time and what the shortfall was for when we had a 2001 recession, what was the shortfall at the state level? When we had the Great Recession, what were the shortfalls and how do we get back to a good position? And so these are some of the projections that we're seeing now for the shortfall. So a lot of these shortfalls look like they're going to kind of be manifested in next year's budget. And so, these are big numbers, obviously. But, we were able to weather these previous recessions. And so it doesn't seem to be, there doesn't seem to be a reason why we can't do it. And also remember, interest rates are really low. So if these municipalities are borrowing money at 2%, 3%, 4%, they're going to still be in a really good position. So I know we got a couple more slides, and then we'll get into some Q&A. So we're right at about 30 minutes. So I know a couple more slides. And so if you have some questions that you have been thinking about, start jotting them in. So when I'm done, I'm ready to jump into the queue with questions. One thing from a stock market update is we have seen earnings growth change. And so we've seen lots of negative revisions, which means companies have been taking what their profit expectations were and they've been revising them downward. That was to be expected. I honestly think too, a lot of companies are just utilizing this pandemic and this crisis to just kind of be more pessimistic about the future. What companies are really good at is under-promising and over-delivering. The classic thing of what companies do is they tend to say, oh, we're not going to have a good quarter. And then what happens when the quarter comes, they beat it slightly. And that's how they kind of get their stock to bounce, because when you surprise to the upside, that gets investors really excited. And so we saw the earnings drop based on these cut-in earnings over here. And this is looking at something called a price-to-earnings ratio. So we're looking at price-to-earnings ratios that are kind of rivaling, 2,000. So obviously that could be a little bit concerning, but because earnings have dropped so dramatically because of the shutdown of the economy, the thing we have to look at as investors is it a temporary valuation issue or a permanent? And we're of the opinion it's temporary. Temporary could be still a year to 18 months to 2 years, but this is not a permanent like 5-year issue that we're going to have to deal with. So, and again, this just kind of shows a sharp decline in earnings forecasts where we're seeing most of these companies predicting massive losses, which we agree they are going to come. But remember, if you're an investor and you look at the health of a company that you want to buy, 1 year of earnings doesn't make the whole value of a company. People look at the value of a company or the value of investing based on earnings and profit over a 10-year period, over a 15-year period, over a 20-year period. They're looking at it over a long period of time, not just 1 year, one snapshot. And that's where we are. And again, the news is bad. It's not going to get better in the near term. This was the oil issue that I was trying to kind of address. So over here on the right side, March of 20, of this year. So this was dealing with storage nearing capacity. So we basically, the reason why oil got to negative is we essentially were at the practical maximum threshold. And so we got up to this threshold where we literally could not store any more oil. And the primary reason is look at global demand. It plummeted. So we've seen since 1960, global gasoline demand has been, this is US gasoline demand barrels per day. Look at the just pretty steady growth. And then look at what happened in this, and this is a per day estimate. Look at where we plummeted to. I mean, back to like the 1970s levels, which is crazy, right? So, once we get back up online, this number will come back pretty quickly, but, we're probably not going to just go right back to normal. I don't know where we're going to settle in, but we're definitely going to see some reduction, maybe some permanent reduction in some of the gasoline demand. But again, that's why we have a big capacity issue, which really made oil prices react funny for a period of time. And that'll normalize, but I do think that we're going to be dealing with, people are switching to electric cars and different versions of, energy consumption. So that's going to continue to potentially, weigh on or lower the need for future gasoline demand. But yeah, pretty staggering number here when we look at that. And then what did I want to go through this one? I'm going to skip this one for time. Okay, so the last slide here, and again, then I'll get into questions. I'm going to make sure we're on the last slide. Yes. So California. So it's a little confusing, right? Because we get the California updates and then we get the county updates. And, even being here in Southern California, we'll have Ventura County doing something different than LA County, that's doing something than Orange County, then something's different than Riverside County, right? So it's starting to get a little confusing of what's going on, and every municipality or every county is kind of handling a little bit differently. So, stage one, make workplaces safe for our essential workers, right? So that's been essentially occurring. So now we have stage two, which is the phase that we've moved into, right? Lower risk workplaces, gradually reopen retail, manufacturing, and then later starting to relax some other restrictions, right? So some of the things that like the guidance for reopening essentially right now is offices that cannot telework, curbside pickup for, malls. Some of these categories seem kind of strange, but the outdoor museums, restaurants, some counties. But, one of the things that's really interesting with this is that LA County just issued that, I think it was the health, I don't know, it's a health commissioner or the health expert in LA County said we might be on this stay-at-home order or safer at home order through the end of July. But that leaves a lot of uncertainty up in the air. I saw that headline today and I was like, well, what does that mean? And I don't know the answer to that. So, because we're starting to see the state open up and the county is taking a different approach, but, certain areas are very different. There's parts of the county that have high density that maybe they need to limit the exposure. There's certain areas like Santa Clarita doesn't have high density. And so I'm not sure how this is going to play out, but it's pretty, I think it's going to be, I think what we're starting to see is, I think cities within the county are going to start fighting back and saying, no, we need to get back to normalcy. And that's going to be a big challenge. And so how does that impact the stock market? Probably doesn't have a huge impact. It might have some impact on local real estate. But it's going to have a massive impact on the psyche of people. Like, I feel like so many of us are feeling like, all right, we're getting close to the end of this. And we know that this is going to be a health issue for probably the next year or two. And we got to be smart, but at least we can get back to work. I mean, we're excited here at Vance Wealth to, welcome most of our employees back. And we know we're probably a few months from that. And then, we're probably not going to be having a lot of in-person meetings with clients because I think most people have been becoming familiar and comfortable with Zoom. But we're hopeful that, when we get into the second half of the year and maybe get into the fall, that we're able to reconnect with people in person, especially those that want to. But the cool thing about learning new technology is I think that we are now getting more used to this becoming a very familiar way to communicate and connect. I was very against just turning on the camera. I don't like looking at myself, and I'm sure a lot of people feel that way. I think I have been giving clients a little bit of a hard time around, well, turn your camera on. And so I think we're getting used to this, and it's in my mind, a much better way to connect, especially if you have a good Wi-Fi so that there's not a lot of pausing. We're getting used to this, and this might be the new reality of people saying, you know what, I don't want to leave my home. I want to do my meetings in my shorts and flip-flops, and I want to relax, and I don't want to get in my car and drive, and I want to save that time, and that becomes more precious. And we're really comfortable doing this and having this communication, and at least with a video, we can connect. I can't see you. I can when I do normal meetings, but in this webinar, I can't see you. So I hope you're all doing well. Just a couple quick little things as we wrap this up. And again, then I'll jump into some of the Q&A. So the conditions are improving. We've seen New York improve dramatically. The US has been a little bit different, but they didn't get as hard hit as New York. So New York is improving. This contact tracing is going to be a really important piece to the puzzle. How we implement it is going to be really interesting because there's going to be more people unhappy with it than happy with it. So we'll see what happens there. Again, we talked about states are unlikely to file bankruptcy again because they're not able to. And then oil is challenged in the near term. But Raymond James does expect a rebound by year end, and that's as demand starts to pick up. So I'll do this now. That way, if anyone needs to jump off while we go into Q&A, we're going to webinars every 2 weeks. And so the next one is going to be Tuesday, May 26th. And so Tuesday, May 26th, and that's going to be at 4:30. Hopefully this is a good time for everyone. Just remember, these are recorded. We send out the links of the recording. So if this is not a good time in the future, just stay tuned and check back in. So thank you, everyone. And I hope you enjoyed. And let's go check out what kind of Q&A I have. So I know it's like drinking through a fire hose with all these charts today. So I am going to jump into some questions. So question number one. So John, with the trillions the government is funneling into the economy, and more importantly, the state of California spending money we don't have, what have you heard on the future additional taxes that will hit us, and when do you hear they will hit us? Okay, so that's a really good question. One of the things that we're not hearing at all is this, I guess, fear or conversation of future taxes. I think being that we're in a crisis right now, people are kind of like, all right, let's just fix things. We'll deal with the ramifications later, which again is a little bit dangerous because we know at some point you gotta pay up, you gotta pay this. And so there actually has been zero proposals around tax changes, other than maybe some of the Trump stuff expiring. The federal government is putting together a package though to actually revisit and maybe drop some of the tax changes of the Trump tax code in order to remove the SALT deduction, the state and local income tax cap. So that would have a huge benefit for California for the next 2 years. So that's a proposal. But honestly, John, I haven't seen, so the question was from John, one of our clients. I haven't seen actually any proposals on how they're gonna add additional taxes, but we're good. Unfortunately, our state and our federal government finds a good way to tax people. They'll find a way to get this back in. But right now, we're not seeing. I have not seen any proposals. So hopefully, the byproduct is this: we're pumping all this money into the system. It might cause a little bit of inflation because there's a lot of money out there, but it keeps people working. And then as people get back to work, businesses start to produce again, that'll generate tax revenue, which will rebuild the coffers of the government, right? And if we have a little bit of inflation and there's a little bit more money in the system, then we'll have higher tax receipts. So we can actually have higher tax receipts without necessarily taxing at a higher percentage just because the economy is growing. So if we can find our way to grow out of this, this doesn't solve this issue, but it makes it more palatable for a lot of us. So, okay. So I got another question. This is from Don. It seems like, let me just say answer live and I'm done. Okay. So it seems like the stock market is already pricing in a V recovery, but seems like it will take some time to recover, especially for some industries. So I feel the stock market may fall back down once the real numbers come out. Okay, so I've been getting that kind of comment slash question quite a bit around, okay, the markets have rallied, and is this sustainable? The early parts of the rally are always the most surprising, meaning the news is still bad and it has recovered 30%. I mean, think of that. It's already recovered 30%. Markets are still negative for the year, but it's recovered 30%. The gains going from here are going to be much more highly selective based on companies and not necessarily broad-based. So I do think while we as a firm believe that the outlook for the stock market over the next 2 to 5 years is going to be quite strong, there's going to be a lot more volatility from now till year end. And there's going to be companies that are going to be thriving, and then the companies that that might be struggling, the airlines, the cruise lines. There's going to be companies that aren't going to get back online. So it's a really tough question to answer. And so I think that's where, from an investment perspective, while we do believe in broad diversification, is making sure that you're owning investments that have maybe some more high conviction, which they're not as broadly diversified, where instead of owning 100 companies or 1,000 companies, they're focusing on 25 or 30 or 40, taking a little bit more of a focused approach. And so the other question from Don was that the good news is, well, this is maybe a tad biased on the real estate side, but I like the question. So the good news is that the real estate industry will help bring us out of the recession with historically low interest rates and not enough inventory. More than ever, people will want to have their own space and home. So, there's been a lot of people who are down on real estate, and you got to remember, real estate is broken into many different categories. Hotel real estate's going to struggle. Office real estate's going to struggle. But things like food retail, why would that struggle? People are going to get used to ordering and eating and actually, I guess, ordering and picking up curbside. We also have, when you start thinking about residential, whether it's individual homes, apartments, things like that, we are so undersupplied with individual homes that we don't think we're going to see a dip in overall housing prices, except for at the home level. You might have somebody who has a forced sale, somebody who unfortunately lost their parents, that now they're having to come in and sell the house, and they're just having to force sell it because they need to settle the estate. So at the individual house level, we might have some deals, some good pricing where people can find bargains. But from a perspective of, are we going to see a massive dip in home prices? We just don't see that. The one caveat is, especially for Southern California, especially I should say for North LA County, is what happens with the entertainment business. So assuming the entertainment business comes back online and they find a way to shoot films and they find a way to have large gatherings, because movie sets have massive amounts of people, assuming we find a way to get reconnected there, then we're probably going to be okay here. But if we see an exodus in the film industry, that could have a much bigger local impact. Not that I'm expecting that, but that's the one caveat that I don't say concerns me, but that I've just been thinking about. So, so hopefully a couple of those questions make sense, and that will wrap up the questions. So hopefully this was valuable. I know it's a little bit different. I'm trying to bring fresh content. So if you guys have topics that you want me to cover, I know a couple of clients have suggested things and we're working on some of the content. So if you have stuff on just basic education that you want us to cover, please let us know. I love covering different topics. I try to do my best research so I can provide some insight to you. Again, I hope that this was valuable to you. We will share the recorded copy via a link. If you have loved ones or friends that you think could benefit from listening to this, please share it. I know we're going to post this through Facebook and LinkedIn. So again, please share it. So our website is vancewealth.com. We do have a YouTube channel. I have no idea what the YouTube handle is on that. But thanks again. I hope you enjoyed it, and everyone stay safe. And as you can tell, I've been getting out and getting some sun. So hopefully everyone's getting out, getting some sun. I think it definitely helps with your mental spirit and your attitude and your optimism when you get out there and get some exercise and some sun. So hope all is well. Thank you so much. Take care.